Hello, everyone, and welcome back to another episode of the Anatomy of the Trade. Today, we're doing something unusual. We are taking the question from the audience, and we're going to go through some of the currencies. Now, I have not done currency trading in probably 15 years. I started my career with the currency trading and traded that for 5, 7 years, and it was really hard just living on the West Coast in the U.S. To stay up throughout the night when the market is most active. Uh, during the, let's say, European session and then into the beginning of the U.S. session. But it was a lot of fun because currencies are usually sustain the trend, and yet they have a lot of intraday volatility based on the events. So today we're going to do exactly that. And the question comes from our YouTube channel. This was the episode that we recorded with France on gold. So thank you for viewing that, for watching, and thank you for all of your comments. And here's the comment, friends, that we have from Hashim Ali. I hope I'm pronouncing the name correctly. I have noticed that the pound and euro against the US dollar had a Wyckoff pattern, well, near the bottom. Well, all of the price structures would have some kind of Wyckoff pattern built in automatically in it, because this is just a Wyckoff interpretation that we put on any structure. And then also the Japanese yen. Can I ask you if you could do the video on the first two currency pairs, so that it could help me to prepare mentally to see what comes next? All right. Well, France advanced me today with an idea that this could be a really good, kind of like off-subject segment for our videos. So France, this is what we're gonna do. So we're gonna look at all three. At the top, we have the pound to the US dollar. In the middle, we have euro to the US dollar, and at the bottom, we have Japanese yen against the dollar. Now, I deliberately did not put the volume signature, and that is because it's really hard to determine which volume signature actually is good in the Forex. So we're going to just analyze the structure, and we're looking at the long-term structure because this is usually what we want to see, a long-term view. So Franz, let me ask you this first question. When you look at the first pairs, the pound and the euro, what could you say about the structure? What kind of catches your eye?
Well, if you look from the left side of the chart across to the right side, you've basically got a trend that is going from the upper left-hand quadrant to the lower right-hand quadrant. Now, it hasn't been continual in that direction, but we entered sort of a trading range, looks like from 2017 to the present, coming out of a downtrend. So that's kind of my initial observation. And one of the things that I've learned from your courses is that typically once a trading range is entered from a trend, the proof that the trend is going to reverse has to be made. Otherwise, the probabilities are higher that once we exit the consolidation period, the trend will continue in the direction that it came in from.
And as we see these sharp reactions obviously associated with everything that the market is going through right now, we see that attempt to continue, to the downside. So now the key is to do exactly what Franz has said. Do we have some kind of reversal here that would negate the previous bias to the downside? And we see that the price actually, let's say in pound, it dips below in kind of like this spring type of action and then comes back up. So what's important right now is for the price to sustain that rally into 130 and slightly above. And that would take us back into the trading range uh, more. So we're looking at this as a trading range. So if we would go, I think that slightly above 130 is going to be a good resistance. So the key is going to be on the intraday right here, and we're going to look at this. The key on the euro is going to be, could we maintain this test? And could we actually break this high right here and then go to 115 and break that, or have some kind of consolidation pattern and then start moving up? And then yen is, a flight to safety in a lot of cases. So we will have to see, it in a slightly different prism. The questions were about the first two, so let's just address that. So with that, let's just go and let's just look at the more intraday price action. And again, this is not the best. Yeah, this is not, apologies, this is not the best. Yeah, here it is. This is more like it. This is exactly what we would want to see on the price. More no gaps, so this is a more accurate data. I like initial recovery. I mean, obviously, such a drastic drop on the daily. This trading range was, somewhat of a classic Wyckoff pattern where you have the climactic action into it. You have the change of behavior on this reaction, on first initial reaction, which is defined by the automatic reaction. And then look at the still vibrancy of the next rally, which ends up as a lower high. So this is our secondary test. And phase A is defined here. What I like about this structure is kind of like this gradual deterioration in both the highs and the lows. So that shows a lot of weakness in the structure itself. And we're looking for phase C. Phase C usually is going to be associated with the second point of excitement. And that second point of excitement you could see in the price action. You don't even have to look at the volume signature. So first point of excitement is our buying climax. And then second point of excitement is going to be the rally that's going to try to come back to the buying climax high. Well, in this case, it doesn't. And that's what's so weak about it, right? So there is a lot of force to push the price up, and yet we're making lower high. And that would define phase C for us. I think a very great point of entry is somewhere here on this bar. Continuation bar, also an attempt to rally and failure. Breakdown also was great. And then some consolidation on the intraday right here. Let's look into that. And then we want to look into this consolidation. But the recovery is actually quite intense. So there is definitely, a lot of buying behind it. This is a big move in Forex, as you guys know. Both of them actually are big moves. So hopefully you've been profiting from this. So let's look on the intraday. All right, well, Franz, let's look at these ranges here. What catches your eye here in this intraday ranges?
Um, and I'll answer that, or try to answer that in a second, but I'd like to just go back quickly to what you're talking about in identifying phase C,
Okay, sure.
which is kind of the final, well, what it does in talking about a second point of fear is it relates the performance or the behavior of market participants to the chart pattern. And I think that's so valuable, because you can just see, weak hands there from the early part of March. Think that it's time for the pound to appreciate versus the dollar, and so, and fortunately you can see from the spread of those bars that there is some some fairly aggressive buying that just gets reversed pretty quickly, but it does look like you can almost see right on the chart the excitement of the participants, and it's the second place that it occurs. So that's just a great way of thinking about what's happening across the
Mhm.
entire trading range. And it works in reverse and an accumulation or a reaccumulation.
Well, let's look at that in reverse mode. Okay, so and we're gonna do this on the intraday. So if we're talking about for distribution, buying climax, um, buying climax being a first point of excitement, and phase C, an attempt to upthrust, a second point of excitement. Then in accumulation, it will be reversed, right? So we're looking at the first point of fear, and then the second point of fear. The first point of fear is going to be associated with the climactic action always, and the second point of fear will be associated with phase C. Franz, do you think that we have this here? I don't know, maybe less defined. What do you think?
Less defined, although the obvious, I think the first point of fear is pretty obvious
Hmm.
when you look at that final capitulations
Yeah.
phase between the 17th and the 18th. The second point of fear, you can sort of see it happening, because between the 20th and the I guess about halfway through the day on the 20th, after that upthrust fails that you've got indicated there, you've got a pretty widespread aggressive move to try to go down. There's some buying that comes in, it bounces around, and then it's almost like in that very last spread, kind of
Hmm.
halfway through the day on the 23rd,
Hmm.
that last bar, that's where I guess the last of the weak
Hmm.
hands are throwing in the towel and saying, I'm done. And, the strong hands are scooping that up, and off we go.
Yeah, this is a good observation by Franz because, we want to look at capitulation bars and they gonna go into the support. So what are the big capitulation bars at the support level? Uh, I would say probably these four, and then the last one definitely has that, character of expansion. So, yeah, from that perspective, Franz, yeah, really good, great observation. So what do we have next? We actually have, three rallies that catches my eye here. So let's look at those. This is the first rally. So this is a better rally than, let's say, anything that we've seen before. So this should catch your eye, especially after the capitulation bar, suggesting that maybe this is the stopping of the whole downtrend. Then a spring-like situation here, and then a much better rally after that. So this should catch your eye for sure, because at this point you will be thinking in terms of the Wyckoff structure, are we experiencing a sign of strength? Now the sign of strength could be a minor sign of strength in phase B, and could be a major sign of strength in phase D. So here becomes kind of like a question, where are we? And then the next reaction, which is this one, would give us that identification. So because the reaction comes back to the support level, we almost like in thinking, okay, this was probably a minor sign of strength that already shows a change of behavior in the way how the rally travels up. So then the key becomes is what kind of character do we have here compared to the character that we had before. And obviously we see shortening of the thrust to the downside. We see in capitulation bars that are contracting relative to what we've seen on the climactic action. And that probably should give us some kind of assurance that off this support, if we have some kind of reversal pattern, then this could be our point of entry. Our point of entry also could be in the middle here before we hit the resistance. That's what we want to do. We don't necessarily want to open our position on the breakout because we know that the expectation is going to be we're going to go into the backup position. So point of entry number one, point of entry number two, and those are kind of like areas. And then we have a point of entry number three area. And here, Franz, could you dissect this for us? This area right here, what do you see?
It's so classic. It's just, we have the rally and the character of that rally from phase C is, I think, picture book sign of strength rally.
Hmm.
Um, then looking at the backing up action, where does the final, where do we end up in the backing up action? Well, we're above the halfway point of the overall range, which is what you'd like to see
Hmm.
as a sign of, this is a temporary, setback. We very quickly recover back above the resistance area that was originally set up in the first automatic reaction, and then just a very nice little absorption area that happens before supply, the final amount of the final supply that's out there
Hmm.
is picked up, and off we go again.
Hmm.
I don't
And
know if that's the kind of dissection that
yeah,
might be like my dissecting a frog in high school
that
biology.
was perfect. That was perfect. Yeah. Uh, one might be a little bit, you know, kind of like surprised by this reaction. But, as you guys know, those of you who trade currencies, this type of reactions are very natural. I mean, obviously, what's unnatural about this type of reaction is just the overall volatility that we are in. But this is the period where we have to adjust our understanding of how the price moves, with what intensity and with what kind of like distance it moves. But this area right here, definitely, overcoming, as Franz has said, automatic rally, and then staying above. And then any type of selling is very marginal. And I'm thinking here that, this was a really good bar to enter. This was a really good moment to add to the position as well. And the breakout is actually acting very nicely as well. In the methodology, in addition to Wyckoff entries, we're kind of like expanding the understanding where better to enter. So we usually would say that we don't want to enter on the breakout of the sign of strength rally, but we want to enter on the breakout after the sign of strength rally, because this is where supply has been already observed at the higher level, and therefore the breakout is much more sustainable. All right, well, Franz, let's imagine that we've got into this position. Let's say here, here, then here, and then here. We have 4 points of entry. Um, in your view, where would be the first time where we would either exit the position or maybe scale out?
Okay, well, following the rules that we've tried to establish in previous AOTs, um, we're looking for significant bars and or areas where we've committed to new highs. And I've never traded currencies, but the thought of it is a little bit frightening to me. So I think I'd probably be using the significant bar rather than you know prior prior levels of commitment, and I would use I'd be trailing my stops uh, up on the as the price moved up using significant bars. So yeah, there would be one. Then I'd place probably underneath that area of support.
Mhm.
Um, I think probably I'd keep my initial stop or my stop as I was trailing at the solid line until we resolved out of that area.
Mhm.
Then I'd probably move up again to that and to that and to that,
Mhm.
and I'd definitely be scaling out, and maybe I'd be completely out of the position because, like I said, the thought of trading currencies
Mhm.
scares me to death.
All right. Well, possible exits here, and Francis mentioned a significant bar. This is, one of the tools that I've been using for my proprietary trading. Um, if you are interested, just come to our website and ask the question, or just, if you sign up for the class, definitely, I'll explain. But one of the things that we could do here really quickly is just to go into the concept there. And I would switch to 4 hours here, because if we're expecting some kind of more sustainable move from here, and let's say we're a little bit more longer term oriented, right? So how would we use the significant bar? So let's say that our interest somewhere here, here, and here. So here is a significant bar. It's the commitment to the upside. It's the expansion of the progress in the direction of the trend with the favorable close. And we usually would want to put the stop loss just behind that. So here is the stop loss. And what we need to do is we need to see any closes below, not just a touch, but the actual close. And we still have not done so. So to me, this is still an upswing in progress. And if we want to go to a much smaller time frame to use significant bars, then we could find some exit points. On the one we saw, on the 1 hour we saw some, and then 2 hours you have to make an adjustment, to the significant bar as the price travels to kind of optimize, what's the best exit strategy based on that. So for instance, if the stop loss is here, next one is here, combination of two bars. This, this is a commitment, but not as big. This is a commitment, probably not as big either. So as Franz said, we probably would be waiting to go through this period until we commit to the upside. So here is that next big bar. Here it is. And one might be thinking that, around the resistance area, we want to be a little bit tighter with our stop loss. So we could move it either to 1/2 of the big bar, or just start moving it to the low of more of the bar that contracts. And still our exit points are going to be somewhere in this area. And this would be a very good trade. Considering our points of entry, multiple points of entry. So something like this. So wow, that's a lot of pips right there. This is just like astronomically profitable. Again, just a function of the volatility. So Franz, when we look now at what's happening most recently in this trading range, how would we characterize the most recent trading range?
Okay. We went up and we had a selling, or excuse me, a buying climax that put us into this trading range. So what's happening here? Well, I think going through and labeling just the kind of the classical Wyckoff structural model, change of behavior, that's our automatic reaction, our initial sign of, our initial test defines phase A.
Mm-hmm.
And it looks to me as though we're still, to my eye, we're still kind of going through that period where supply and demand are slugging it out, so to speak. And in this latest uptrend from about 3/4 of the way through the sixth through now, it looks like at least for now, demand has the upper hand on supply, but we've entered this area now where it's kind of what's going to happen here. Are we going to, absorb supply at this level and then be able to move higher, or are we going to see supply come back in and push us back down to the lower end of the resistance portion of the trading range? That's the way I'm looking at it.
Mm-hmm.
I'm not ready to do something at this point.
Yeah, probably not a big edge, where we are. We usually would like to initiate the position off the reaction, right? So when reaction happens, at the reversal of that reaction, and that usually will produce some kind of more favorable point of entry. Important observations here is that, we retraced some of the rally, but look how small this retracement is. So that is in line with the continuation pattern. That's number one. And then if that's the case, we want to observe where supply occurs. So now we don't have the volume signature here, but it's not really necessary to have the volume signature to understand where supply might have come in. So for instance, we could see that there was some selling at this point, and then there was stopping. The tail on this bar, on this capitulation bar, suggests that there was some demand there. And demand comes in, tests, and produces the rally into the buying climax high, which almost touches this high, which is also a point of strength, structural strength. Inability to go down right away, also a really good point. Retouch of that buying climax high, again, a really good point. And then we're seeing again some supply coming in. What kind of quality of supply is that? Well, the spread is not that big, right? So it's not as big of a spread of as the automatic reaction type of spread. So that's encouraging as well. Even though we're making a new low in the sprint type of action, the price recovers. So also a good bullish sign of recovery of the support. And then on the way up, what kind of selling do we have? Somewhat, of um, you know, subdued selling, not very aggressive. But the key here, I think that if the selling goes down, um, demand also is not that active, right? So we don't see this type of activity, this type of volatility on this rally. And that could be suggestive that, we're kind of drifting apart more in the technical type of rally for now. And we need more active supply to come in and more active demand to come in to produce some kind of absorption around the resistance and for us to start going up. If we only have active supply, possibility of the retest is there, and here we would have to again judge the character with which the price moves down, and then to define where exactly it would go to which point. So there's still some work that needs to be done here. But this area, for instance, strikes me as kind of like, yeah, there's not very aggressive supply, but demand is also not that aggressive either.
Thank you, Rahman. Very well said. And one of the things that I just like to add real quick to what's happening right there at the extreme, at the last bar on the right, is one of the things that I've learned from you, and that is to have an open mind, which you went through a couple of different scenarios about potentially what could happen. And I've had a bad habit throughout my long life of looking at one possibility and then kind of letting that become ingrained and thinking, well, that's what's going to happen and I'm right about it. And that can be disastrous to trading results. So as I'm sure everybody else has experienced the same thing at some point in their trading experiences. So being able to look at different possibilities and evaluate, well, this might happen, and if it does, this is why it's going to happen, but this might happen too, and if it does, this is why it's going to happen, gives you just a much better kind of contextual situation for your own trading to figure out where do I have my edge and when is a good time to be taking a stab at this. So it's just, looking at alternatives is just a wonderful lesson that I've learned from you, which I can't tell you thank you enough.
Well, then thank you, Franz. And really good point here to think about also, like, okay, well, how would the different scenario look like, right? If we're in the rally, continuation probably is going to be simpler than the reversal, right? Continuation might be just some kind of reaction and then the new high here. Supply might increase at this point, but so can demand. What about a reversal? How would it look like? Well, probably something like this. Probably something like this. It pays a lot to look at the history of how the price behaves at the same contextual spots. So we're looking at the points of the resistance And if for continuation, we need to see something different than the first three instances of this trading range. And once you see that different behavior, then you could bet on the continuation. If you're seeing the same type of pattern, where maybe we're seeing some test into the high, test into the high, test into the high, and this test later on fails, and we see that failure throughout, this type of pattern, then this would be an indication for the trade to the downside. So sometimes not fully committing to the bias, but using the current structure and contextual analogs within the structure as a confirmation of a certain signal to the upside or to the downside is a better approach than just making the analysis and, as Franz has said, kind of like, putting yourself in a very, very subjective way of thinking. So I think this is a great stopping point, Franz, on this thought, just, the way how we would be thinking about the analysis here more tactically rather than, uh, trying to marry to a certain specific idea.
I think it is too, Roman. And for those that are listening, I don't know if that was a 2-minute segment or a 3-minute segment, but I think it would pay all of us to go back and listen to that several times and really absorb the knowledge and experience and lessons that were just taught to us about this,
All right.
what's going on here.
Sounds great. Well, thank you, Franz. Thank you, everybody, and thank you for your question. We hope that you enjoyed this segment of the anatomy of the trade, and we will be back next week with the next episode. Thank you.
Thanks, Roman.